Good morning and welcome to the Killik and Co market update. Markets have been quite wobbly this week and there are various different issues causing concern. We've got the situation in Afghanistan, we've got the spread of the Delta variant, we've got renewed concerns about the US starting to taper its asset purchase program, and finally we had some weak data coming out of China. So let's take a look at the Chinese situation in a bit more detail. The data that really spooked the market this week was for Chinese industrial production. So here's a chart showing industrial production in China for each month in comparison to the same month of the previous year. Now, the Chinese economy virtually shut down in January and February 2020. So if we compare those 2 months to the same months for this year, you can really see quite a dramatic change. However, since then, the data has really started to tail off, and the data for July in particular of this year came in quite far below expectations. Now, the Chinese economy buys quite a lot of commodities from the rest of the world. And in fact, big miners such as Rio Tinto and BHP earn about half of their revenue from China. So if industrial production is really slowing down, that's potentially bad news for miners. And we have seen quite a lot of weakness in big mining stocks this week. The FTSE 100 is particularly exposed to these big mining stocks, and therefore the index has underperformed other major indices over the course of the last week. For example, on Thursday in particular, the FTSE 100 was down 1.54%, whereas the S&P 500 in the US was up 0.13%. This week, the UK government published its hydrogen policy. Usually when we think of low-carbon power sources, we tend to think of electricity, but there has been an increasing focus on hydrogen as an alternative low-carbon power source, and the UK government in particular has big plans for it. Here's a chart that we took from the policy document, and it predicts the potential percentage of our total power that could come from hydrogen by the year 2050. So as you can see, the expected range is between 20 and 35%, which really is quite a significant proportion. At the moment, we don't really use any hydrogen at all, but if we were to get to a point where 35% of our total power came from hydrogen, then we would require some big increases in demand for hydrogen from different sectors. So here we've got a chart predicting this. We would expect to see a big increase in demand across industry, across power, i.e. electricity generation, across heating for homes, and also across transport. The rest of the world has also been looking at hydrogen too, and this has been good news for a company called Linde, which is an industrial gases company with a big focus on hydrogen. So do give us a call if you'd like to hear about this in a bit more detail. And finally this week, the latest Japanese growth numbers were quite far ahead of expectations. And we just thought we'd highlight this because the Japanese market is quite often overlooked. So here's a chart showing the performance of the Nikkei 225 versus the FTSE 100 over the last 5 years. And as you can see, the Japanese market has significantly outperformed. It's fair to say that the FTSE 100 would have paid slightly higher dividends, but even accounting for that, the Japanese market has significantly outperformed. There are some really interesting companies listed on the Japanese exchange, so do give us a call if you'd like to hear about some of these in a bit more detail. Moving on to have a look at next week, we're expecting results out from Salesforce and Ping An. That's it from us. Enjoy the weekend, and we'll see you next Friday.